All right, if you're a US citizen living abroad, you already know what a headache taxes can be. But listen, there are two huge tools that can save you a ton of money. But, and this is a big but, picking the wrong one could literally be costing you. So let's figure out which is right for you. And hey, if you're a parent, you really need to lean in for this part. Because this isn't just about saving a few bucks. We're talking about the IRS sending you cash. A single choice on your tax return might be the only thing standing between you and a pretty big refund, year after year. So here's the deal, right? As a US citizen, you're on the hook for taxes on your worldwide income. Doesn't matter where you're living. But the whole point is not to get taxed twice. And thankfully, the IRS has a couple of powerful ways to make sure that doesn't happen. Let's break them down. Okay, so your two main weapons in this fight are the Foreign Earned Income Exclusion, we'll call it the FEIE, and the Foreign Tax Credit, or the FTC. Now, at first glance, they kind of look the same. They both help lower your US tax bill. But trust me, how they get there, totally different, and those differences have huge consequences. All right, so let's pop the hood and really look at the mechanics of how these two work. Seriously, understanding this part is the key to getting it right. Okay, so on one hand, you've got the FEIE. This thing lets you just exclude a massive chunk of your income. We're talking up to around 130 grand. It's almost like you make that money invisible to the IRS. Poof, it's gone. Then you have the FTC. This is totally different. You tell the IRS about all your income, but then you say, hey, I already pay taxes on this to another country. And you get a dollar-for-dollar credit for those taxes. It's basically a giant coupon that just wipes out your US tax bill. Now, this is where things get really interesting. And honestly, this is the part that so many expats completely miss. It turns out, the best strategy for you might have nothing to do with avoiding tax, and everything to do with a huge tax credit for American families. Okay, look at that number. And the magic word here is refundable. This isn't just about reducing what you owe. No. The additional child tax credit means the IRS could send you a check for up to $1,700 per kid, even if you owe zero in US taxes. I'm talking about cold, hard cash in your bank account. So that leads to the million-dollar question, or I guess the $1,700 question. How is it possible that one of these tax strategies, one of these tools that's supposed to help you, could completely block you from getting this money? What's the hidden catch? And here it is. This is the rule that trips everyone up. It's called the FEIE disqualification rule. Basically, the IRS says if you use the Foreign Earned Income Exclusion to wipe out your income, well, you can't also claim the refundable part of the child tax credit. By making your income invisible with the FEIE, you accidentally make yourself ineligible for that cashback refund. Let me put it as simply as I can. The FEIE helps you avoid paying taxes, but the FTC can help you avoid paying taxes and get you a refund. Big difference, right? All right, that's enough theory. Let's see how this actually plays out with a couple of real-world scenarios. This is where the rubber meets the road and you can really see the financial impact. But before we dive in, just burn this one idea into your brain. The entire decision, FEIE versus FTC, pretty much boils down to one single factor. What's your local tax rate? Are you in a high tax country or a low tax one? Okay, meet Rachel. She's a teacher in Qatar, a country with zero income tax. So look at strategy A. If she uses the FEIE, she just excludes her 72 grand of income. Her US tax bill is zero, and that's it. Simple. But what if she tried strategy B, the FTC? Well, she has no foreign taxes to claim a credit for, right? So she'd actually end up owing the US around $4,000. Ouch. In this case, FEIE is a no-brainer. It's the clear winner. Okay, now let's switch gears completely. Here's David, a consultant in high-tax Germany. If he uses the FEIE, sure, his US tax is zero. Same outcome as Rachel, pays nothing. But now, look at what happens with strategy B, the FTC. The crazy high taxes he's already paid in Germany give him this massive foreign tax credit. It completely wipes out any US tax he might have owed. And here's the kicker, because he used the FTC, he is still eligible for that refundable child credit. So he pays zero tax, and the IRS sends him a check for $1,700? I mean, come on, that is a huge win for the FTC. Okay, so let's boil this all down into a simple cheat sheet. You're probably going to want to choose the foreign tax credit, the FTC, if you live in a high tax country. Think places like the UK, Germany, Canada, Australia, and you have qualifying kids. Basically, if your foreign tax rate is higher than your US one, the FTC is your friend. Now, the FEIE is almost always the way to go if you're in a low or zero tax country, like the UAE or Qatar, or if you don't have kids who qualify for that refundable credit. And really, that's the key takeaway here. Look, getting your tax bill down to zero is great, but it's just step one. The real power move is picking the strategy that not only does that, but also unlocks potentially thousands of dollars in cash refunds for your family. If you've got a couple of kids, this one decision could swim your finances by thousands every single year. But wait, before you rush off to change your tax strategy, there is one last critical thing you have to know. If you've been using the FIE for years, and now you decide to switch to the FTC to grab that credit, you are officially revoking your FIE election. And the IRS has a rule about that. They generally will not let you switch back for 5 years without getting their special permission. So think about this. This isn't just a choice for this year. It's a long-term strategic decision. Are you sure you're making the right call for the long haul?